Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson alongside Kriti, Gupta and Lizzy Burden. We've got about an hour to go until cash trade here in Europe. So what do you need to know this Monday morning? Iran's president and foreign minister are confirmed dead after their helicopter crashed in the mountainous northwest of the country. RyanAir full-year numbers meet expectations, but the carrier warns that fares may be flat this summer and that Boeing may not deliver all of the 737s that it currently expects. And copper surges to a record and breaks above $11,000 a tonne. Gold also hitting a record. Stocks are bracing for Nvidia numbers this Wednesday, Kriti.
Yeah, sticking with the market story there. On Friday, 14 out of the 20 markets closed higher around the world. The rally continues in futures trading this morning. Your stock 50 futures higher by 0.2%. A similar margin for the FTSE 100. Strength in the European currencies as well. Euro dollar 108. Cable at 127.09. Markets today starts right now.
Monday, the 20th of May. Good morning, folks. The first thing we need to say is we welcome back our Spanish correspondent. I'm sure we're going to be getting an updated report on the latest on the Spanish economy a little later on the show.
I have so much to say. So much. you just give me the cue, Guy, and I'll rattle it off.
The RyanAir CFO was just saying book now. Kriti doesn't need that advice. She's already taken it.
Yeah. I've been churning the Spanish economy for months now, just booking this travel, and it'll finally show up, I'm sure, in the data in the next couple of weeks.
We'll see it in the numbers a little bit later on, without a shadow of a doubt. Look, there's lots going on this morning. I think we need to talk about what's happening in the metals market. We'll do that. You've got copper absolutely surging. Gold's on a tear as well. I'd like to flag as well the VIX. Look at the VIX. The VIX is really dramatic in terms of its move to the downside. There's no volatility in this market when it comes to equities. We didn't see a record close on Friday, but I wonder what's going to happen this week. There is one thing on the agenda for me this week. Maybe we'll talk about PMIs. Maybe we'll talk about a sort of geopolitical risk. There's a whole ton of Fed speak as well coming through.
Yeah.
But there is but one event. And we'll put up the week ahead for you. There is but one event, and that is Nvidia.
There is. I'm waiting for Nvidia to crack further. The options market is so interesting when it comes to these Nvidia earnings, because every time Nvidia reports, the options around or I should say the bearish bet on Nvidia gets cheaper. I don't know if you've noticed this. And everyone's waiting for it to crack, and it still hasn't, despite the fact that, the higher it goes, the more odds there should be that it should. And here we are. Everyone's betting against it. Nvidia defying gravity.
So what I think is really interesting is the skew is actually much more muted this time. So normally you have a big upside skew. To your point about what happens on the downside, which would affect that skew as well. But actually the market this time around isn't maybe expecting fireworks.
Yeah, and good is just never good enough in this space, is it? So we already had advanced micro devices 10% down at the start of the month, even though it raised its sales forecast. You had super microcomputer down 14%, even though the earnings report had forecast for revenue and profit that went above and beyond estimates. But the good news is you've had already that TSMC report of higher sales in April. Could be a sign of good news to come for Nvidia.
Yeah, it's Nvidia, ASML and TSMC are the three stocks you basically want to watch when it comes to what is happening with the AI trade. A couple of things I want to flag as well. Mike Wilson. I had to double check. Mike Wilson raising his target over at Morgan Stanley to 5,400 on the SPX.
Yeah.
He's talking about a sunny environment. I had to double check that as well. Yeah. Maybe that's the biggest bear signal going.
I was going to say the Uber bear turned bull for a moment, I suppose. It's interesting when we're talking about this in the context of Nvidia earnings, though. Is Nvidia a macro story or a micro story? If Mike Wilson is talking about the sunny macro environment, are we then talking about kind of a risk-taking environment where momentum trades are more favorable? Is that where Nvidia falls in? Or is Nvidia fundamentally a changing of the guard kind of story when it comes to the technology space? And that's kind of what I can't put my finger on still when we talk about this market action.
But it's also just the momentum has just been enormous. And that's just given the market so much momentum. Yeah. And you wonder if that was to start to crack, whether or not how quickly that momentum trade would fall apart around it as well. Yeah. The VIX story, I think, is fascinating. This is a market that basically has, in some ways, kind of gone to sleep. The upside story is there. It's really positive. You can keep trading that. Mike Wilson's talking about a sunny disposition for these markets. But you look at the VIX, below 12 is an amazing read and just tells you that this is a market that is largely kind of discounting now the tails. It doesn't worry about the tails. It's not worried about stagflation. It's not worried about what happens with inflation. It just seems to be believing that we're going to get this immaculate disinflation. The soft landing is back on. The Fed's going to cut. We're going to hear a lot of Fed speak this week. We've also got quite a lot of UK data we need to delve into as well.
I was going to say, speaking of immaculate disinflation, in the UK we get CPI numbers on Wednesday. This is potentially going to be back below target, and it would be the first major economy for that to happen in this cycle. So it would be significant, but there's a lot of risk the other way. It's something that
I was about to say, what are you hearing? What is the risk the other way? Because we're coming down from kind of 3s into the 2s. What is it? 3.2 to 2.1 is kind of where the market is reading this right now. But what is the risk that we actually see stickier inflation, and that throws this idea that we get 2 rate cuts and the BOE off?
Exactly. Well, you've already had RBC Bluebay saying that it's worried about this upside surprise, and if you get one, then bets on a June cut would be unwound. So currently it's a coin toss for a June cut. Maybe we don't see that after this print. It also has political consequences, of course, as well, because halving inflation by the end of last year was the Prime Minister Rishi Sunak's top target. He hasn't managed to capitalise on that politically. So even if they get back to 2%, maybe it still won't translate into votes.
We need to, one of the things that's been driving the FTSE 100 has been the metals trade.
Yeah.
Wow, gold.
Massive,
but copper as well. Absolutely amazing. We were talking to a lot of people. You weren't here last week. We'll talk about Spain later on. But what we were hearing was that actually this is a speculative trade. And this goes back to this idea that the market is just on a tear right now, that the speculative trade is so strong that it's not being seen in the physical market. In fact, the physical market's quite weak right now, which is kind of a weird dichotomy.
But this goes back to the point we're making about Nvidia, right? Is this a risk-taking environment where there's room for that speculative kind of trading, where there is that kind of understanding? There's 2 points I want to make here. Following up on Lizzy's point about the UK CPI numbers, there was a great chart on LinkedIn I saw, actually, of Steno Research coming out, saying that if you're looking at some sort of leading indicator for UK CPI, look at the average selling prices for the next 3 months. They are ticking higher, and they're ticking higher in a very dramatic way. Those two charts track each other so closely, they're saying that's the kind of leading indicator you really want to point out to. The other side of it, and this is where I'm going to bring Spain into the picture, at least Latin America, if we can, Hispanic America, the Maradona theory, I think, is relevant here.
Kriti's going to talk about football.
I'm going to talk about football. I'm a World Cup fan. I'm not like a regular soccer fan. But
right. We don't call it that, by the way.
She's done it already.
Yes, I know, but I have to.
It's a game we play with our feet. It's quite simple.
I can't go into this conversation.
Yep.
The Maradona theory. So, again, a part of my Costa del Sol beach time reading was this theory that back in 2005, Marin King, the former BOE governor, made this reference about the way that central bankers should be communicating, that they should basically be following Maradona's approach to goal setting, which is go straight, stick to your kind of narrative around this is our inflation target, don't really deviate from the path, and it's a straight shot. For anyone who knows that second goal in the World Cup, this makes a lot of sense. I can't go into the details right now of the football/soccer, but the point I'm trying to make here is that this is where Chair Powell and Andrew Bailey have deviated from the path. They're not making that straight shot anymore. They did for 2 years, for 2-3 years.
Because they're data dependent.
In theory, and they have been, for the last 2-3 years, but even when the data was not going in their favor, they said it was transitory.
And when you've got inflation about to be at target, how could you not, many will ask, cut rates already when there's a lag in monetary transmission, and when you've got the political pressure, the Chancellor Jeremy Hunt already saying that rate cuts would be a feel-good factor for voters?
Do you want me to, let me lean the other way on the consumer story, though. And that is that you look at what RyanAir is saying. Neil Sorahan was just on our air just a few minutes ago talking about the fact that we could see flat fares this summer. This is when you've got Wizz Air with engine issues with the Pratt & Whitney engine, so it doesn't have the capacity in the air that it normally would have or would expect to have. RyanAir isn't getting the aircraft from Boeing that it would had expected to get. So the capacity is not there, which in theory should push fares higher, but it's not. If RyanAir, the biggest low-cost carrier in Europe, is saying we don't think fares are going to be that high this summer, that tells you something about demand.
Is that, and I know that's a very specific kind of airline transportation story, but I'm also wondering if that expands to this capacity issue you see in other places in the market as well, which I think circles back to the Nvidia story as well. You see weakness in the copper market, you see weakness in the metals market. Is this kind of, I'm starting to feel like there's a deja vu story here, where if you're concerned about inflation ticking up higher, the focus is kind of circling back to supply constraints as opposed to demand weakness.
Well, I'm wondering if the RyanAir story is a demand weakness story.
As opposed to a supply.
So you've got the supply. In theory, the supply should push fares higher, but there isn't the demand, and the demand that we've seen post-pandemic has been in services, exactly in this kind of trade, i.e., people wanting to go and have experiences rather than buying physical goods. And if we're starting to see Europe's biggest carrier going, actually maybe we're not seeing the demand to drive fares higher because they do dynamic pricing, then maybe that's something we should pay attention to.
So is that then Andrew Bailey's and Chair Powell's worst nightmare then, that you have this demand weakness coming at the same time as supply chain weakness? Wasn't this the exact story in 2021 where there was this concern that
that's deflation,
some sort of that there was some sort of pullback, and now you're seeing it on both sides?
Yeah.
Lizzy agrees.
Yeah, there we go. But I think that's where we want to pay attention, because that, when we saw it in the CPI data, and I'll be waiting for the CPI data out of the UK this week to see whether that services side inflation is where the strength lies. Because there's another bunch of factors that are coming to the mix there as well on the wages front, which is that we've seen the minimum wage going up, which is pushing the services side higher as well. So I'm just, this whole idea that services inflation is going to remain strong, just the RyanAir story just slightly leans in on
What
that.
is the market trade there, though? I mean, it's fascinating because at the same time, you're talking about the currency impact from the rate story. You're talking about even the stock impact from the kind of demand story as well. Then you got to factor in the geopolitics, and that's where I think perhaps the commodity story matters a little bit more. Are we seeing more reactions in oil prices?
No.
We've talked about, correct, right? But is that kind of a hidden risk that we're waiting for to show up in the data eventually?
Maybe. The biggest thing... Previously, I thought the biggest danger for the market was that you would see a no landing and a hard landing.
Yeah.
But I think there's another risk as well, which is the stagflationary kind of story, which is going to be really interesting to see how the markets navigate as well. You bring up geopolitics. We should probably talk about what's happening in Iran and the fact that we have seen Raisi and the foreign minister in the same helicopter in this crash into northwest of the country. I think it's going to be really interesting to see how the region navigates this now, and ultimately who replaces him. Jumana Basechi is waiting for us to talk about this, so let's go straight to her to get the latest on this story. Jumana, what do we know about how the helicopter crashed, and what do we know now about where this leaves Iran?
Yeah. Hi, Guy. Good morning to you guys. Well, it took a while for us to get full details. The weather conditions in Iran didn't help, and it took the course of the evening for us to finally get confirmation that the rescue mission had reached the site of the crash, the helicopter crash, earlier this morning around 6 a.m. local time. Iranian state TV saying that all people on board, there were 9 people on board that helicopter, had indeed died in that accident, of which, of course, Iranian President Raisi and Iranian Foreign Minister were also on board. So that has happened now. Just in terms of what happens just in the near term, per the Constitution, the Vice President, that is Mohammed Mokbar, he's going to step into the role of President. But per the Constitution, there are 50 days for another presidential election to be held. And it is coming at a time of a lot of turmoil for the Iranian regime. You don't have to go so far. This is a regime that is set back by a huge number of sanctions. The economy is in decline. In addition, President Raisi was seen as a main conduit for the Ayatollah to pursue some of these more hard-line, strict approaches just internally towards the domestic social economy, but also vis-a-vis international relations as well. Don't forget that President Raisi also spearheaded that direct confrontation with Israel about a month ago too. So it does raise a lot of questions as to who is going to take over, not just as president when the presidential elections take place within this 50-day time window, but also who will succeed the Ayatollah himself. President Raisi was seen as a protege to him. The other person in the mix is his own son. But if that does happen, and if the power goes from the supreme leader to his son, then again, we're getting towards or moving towards a hereditary power sharing situation, which is exactly what the Iranian regime overthrew in 1979. So again, very interesting questions about the future regime and what it means for their policy going forwards.
Jumana, thanks very much indeed for updating us. Horizon's anchor Jumana Basechi joining us out of Dubai. We've also got the situation evolving in Saudi. We've got the situation evolving in Israel as well.
Yeah.
Significant power shifts taking place in the Middle East. Hard to map out kind of what happens next. We'll do a little bit more on that a little bit later in the program. You want to talk about this story in the Journal?
I do. This is, I think, a really important story, and I think as we're kind of waiting for the geopolitics to kind of weigh on perhaps how the Federal Reserve thinks, even how U.S. politics shape out as well, there's a story that I think everyone needs to know here, and that is this capital markets kind of shift that is coming out of the Federal Reserve. The Wall Street Journal reporting over the weekend simply that this plan, this capital rules plan about how much capacity, how much reserves that a lot of these banks need to hold on could actually be substantially cut down. This was a policy that Elizabeth Warren, among many, many others, had really been pushing for creating a bigger cushion for some of these banks. Jamie Dimon and his peers saying you cannot pull back on the lending. It makes this economy not run as well. It's a very hawkish stance in the way of kind of pulling back some of the lending capacities of the banks. And it looks like that lobbying won, now bypassing Michael Barr. So reporting out there that even the likes of Jerome Powell may be pulling back a little bit by about as much as 20% on some of those lending rules.
Which speaks to the change in the balance of power between the banks and the regulators, maybe even capitalising on the splits at the Fed.
It's been amazing to see the influence Jamie Dimon's had on this.
I was going to say, he's quite the lobbyist.
Barr's talking about the fact that he has been inundated.
Yeah.
Inundated in terms of the lobbying that he has seen. But it's interesting to Lizzy's point about kind of the regulatory balance. This was something they really came out fighting on, though.
Yeah, well, the timing is everything here, right? We're talking about a time when the Federal Reserve as well is trying to not have as much of a hawkish stance. Yep. It makes just as much sense that the banks are going to be in on that as well. It's something that we're going to dive into throughout the show as well. But keep an eye on that reporting and what the developments around that plan look like. Coming up on the program, however, we go back to the corporate space. RyanAir forecasts fares could be flat this summer. The Irish carrier looks to rev up bookings. We'll discuss the company's earnings later on in the show. Plus, UK house prices ease slightly this month. We're going to discuss that and the outlook for inflation. Those numbers coming up later this week. But up next, hard commodity prices are soaring. Gold especially moving on those rate cut hopes out of the Federal Reserve. We're going to check the markets and economic outlook next. As always, if you have any questions of your own for our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
Welcome back. In some ways, it's a very quiet week. We're not going to get the big data deluge that we've been having over the last few weeks that really has dominated the agenda. This week, it's more of an Nvidia focus, but there's a few things you really want to pay attention to, one of which is the PMI data set we're going to get later on in the week. But Wednesday, we're also going to get UK CPI data. Now, there's this expectation that we're going to come down quite sharply. Is the risk to the upside or the downside on that move? Jennifer McKeown, Chief Global Economist at Capital Economics, joins us now. Jennifer, the UK story is quite interesting in as much as if you were to see sticky inflation kind of remaining sticky, the UK is probably the place that you might look. And I'm wondering if elsewhere we will take our cues from what happens here in the UK this week. What are you expecting on the data? Does this trend lower continue?
Yes, I really think that it does. I mean, you're absolutely right. It would be reasonable to be looking to the UK for evidence of sticky inflation. But a lot of that, of course, has been related to the way that energy prices are regulated in the UK, which has meant this significant delay before lower oil prices could feed through to the prices that households are paying. What we're expecting to see today is that cap changes again, is that inflation comes back down to, we're actually forecasting below the Bank of England's target, so to 1.9% in April. Now, the risk to that skewed a little to the upside, but I think it's pretty clear that you're going to see quite a sharp decline today, which will be really encouraging for the Bank of England this week, on Wednesday.
Yeah, Wednesday. If that comes through, can we confirm 2 rate cuts this year? Is that, or is the risk that how important will this data be in determining whether we do get those 2? How important is this set in particular?
Yeah, I think it's very important, given that it's the month when when Ofgem changes its cap, so we will be looking to see the energy effects. Also, core inflation, I think, is likely to come down pretty sharply, and this month in the UK, maybe to something like 3.5%, which is still a bit high for the Bank of England, but much better than it was. So, yeah, I think this is going to be a pretty crucial release, combined with labour market data that are upcoming. I think that these are going to be pivotal. I think we'll see more than 2 rate cuts from the UK this year, partly because I think there's quite a lot of spare capacity in the UK economy, unlike the US, which should mean that core inflation keeps on coming down as the year goes on.
So, Jennifer, just to be clear, do you think they'll cut in June and then in August so they can explain themselves at the press conference? Because surely that would set up an expectation in markets of back-to-back cuts.
Yes, I think. I mean, it may be August, it may be a little later, but yeah, I think that is pretty likely. And I think back-to-back cuts are not really out of the question. It depends a lot on how the UK economy progresses. We know that in Q1 the economy was relatively strong, and if that kind of pace continued to was sustained, then the bank might hold off. There would be concerns at that point that the economy was starting to run a bit hot. But as I said, I think there's quite a lot of spare capacity there, assuming, as we anticipate, that activity starts to soften again in the months ahead, and the Q1's 0.6% gain wasn't a sign of things to come, then I think we'll get significant cuts from the Bank of England this year. We actually have interest rates ending the year at 4% in our forecasts.
Well, Jennifer, let's stick with that theme of back-to-back cuts and go from the Bank of England to the ECB. We have Ismail Schnabel over at the ECB saying that back-to-back cuts aren't warranted there. What difference does it make in terms of the actual effect on the real economy between going June and July at the ECB or June, wait a little bit, and then go again? What's the difference?
There's not a massive difference in terms of the impact on the economy. Of course, 25 basis points here and there when rates have risen quite so far, and that they're clearly really restrictive in the Eurozone. I don't think 25 basis points July, August makes all that much difference. But the perception that would come from that back-to-back cuts is obviously quite different and would need to be couched in quite careful language around what might happen were inflation to pick up again, what might happen if the economy were to accelerate sharply. But I think in the Eurozone that there's relatively limited risk of that. We know already that inflation is doing better than elsewhere. The core rate's already at just 2.7%, which isn't that far off the ECB's target. Wage growth is still a bit sticky, but we've got some negotiated wage data coming out of the Eurozone later this week, and we're anticipating that they'll show a further cooling too. So I think everything's really going in the right direction so far as the Eurozone is concerned. And activity still looks it's rising now, which is an encouraging sign, but clearly not overheating, accelerating very rapidly. Nothing really to worry the ECB that price pressures are going to pick up again.
So in our last minute here, nothing, it seems like, to worry for the ECB, but what odds would you put of that reacceleration? You're starting to see that a little bit in the periphery. You saw it in the Italian data. You saw it in the Spanish data as well in the last couple of prints. Some are kind of pushing that away and saying, well, that's a different economic story. Spain is outperforming, for example. Italy, driven by a lot of fiscal spending. At what point does the ECB start to worry about those kind of numbers?
Yeah, well, I think it's when they're feeding through to the Eurozone aggregate. The ECB can't do an awful lot about what's happening in individual economies. It needs to obviously look at the averages. And if we look at Germany, for example, clearly the economy is an awful lot weaker. It's a very large part of the Eurozone. So I think that's going to be equally important, more important than what's happening in Spain and in Italy. Something the ECB has been looking at is the survey measures of services price pressures. Those are quite important, and those had been edging up a bit. So the PMIs this week are going to be important for judging whether that trend has continued or whether they're starting to come off. Profits too, really important. The ECB's made clear that it wants to see some signs that profit margins are starting to be squeezed in response to previous economic weakness. We think that is going to happen, but it's another one to watch.
All right, Jennifer McEwen, Chief Global Economist over at Capital Economics, we thank you so much for diving into some of the details of not only the European economy, but the UK economy as well. Coming up on the program, we continue that conversation. Inflation data on Wednesday in focus. It's the next key test for the UK economy. Bouncing back strongly from a shallow recession, we ask if the country's recovery is on track. This is a conversation you don't want to miss. This is Bloomberg.
We all talk about wanting to go back to 2%. Every single quote you had this morning assumes that 2% is the right inflation target. 2% is totally arbitrary. We should all realize that if we are pursuing the wrong inflation target, the risk of a mistake, and that mistake would mean sacrificing growth unnecessarily, the risk of that mistake is high, especially when the low-income people are most at risk.
All right, Bloomberg opinion columnist Mohammed El-Arian talking about a 2% inflation target being completely arbitrary. Haven't we seen this movie before? I will make my Maradona theory quote again, but haven't we seen this movie before where everyone says 2% isn't the right target? It requires congressional approval over in the United States. I'm not really sure what the process is here in the UK. I'm having a lot of deja vu this morning in terms of the inflation commentary.
Theoretically, it is an arbitrary number. If you think about this sort of theoretically, yes. The problem is, though, it would require quite a significant change in mindset to go to a different inflation target. And in some ways, it is just an arbitrary number. But it does require the implications of admitting that we are in a 3% world rather than a 2% world are quite significant.
And then you just change the goalposts, and then you don't hit that target either.
Yeah, and then you change it again, and then...
Change it to nominal GDP, and you can't measure it properly, and you don't hit that either. This is what governments are for. Fiscal policy is there for a reason.
But isn't this where the commentary comes? If you're looking for a long-term inflation target, what is long-term? Are we talking about since 1999? Are we talking about since post-COVID? What is long-term? Or are we going back to, 1950s? I don't know.
Whatever average you hit it over.
Yeah, basically. I don't know whether we are in a 3% inflation world or in a 2% inflation world. I guess in the UK we're going to find out this week we're probably in a 2% inflation world. But there's the risk that we actually go below that. So in the States, maybe it feels like a 3% world, but elsewhere, and maybe to your point about fiscal, that's where the difference lies.
Yeah, and we have
Lizzie's point.
We have got that UK inflation data coming out this week. We've also had a raft of other data. We've had the Rightmove numbers coming out this morning. This is, of course, for house prices, asking prices, I should note, rising month on month, 0.8% in May to a record high. We can discuss that now with Yolanda Barnes, Chair of the Bartlett Real Estate Institute at University College London. Lovely to have you with us on set, Yolanda. Hello. Whatever happened to this double-digit drop in house prices that economists were warning of?
Well, I think economists didn't factor in the way that inflation would strip out value in the housing market. Inflation, as it were, has done the job of devaluing housing. And I think this year we're going to end up 3-5% higher.
And do you think that with the UK election on the horizon, there's a sense that people might be holding back on selling their properties in the way that they might have done before the Boris Johnson versus Jeremy Corbyn election, or is this just a different scenario?
It's very difficult to establish whether elections affect housing markets, especially as the timing is so completely uncertain. Could be next January. But the big casualty, if you like, of uncertainty that's more to do with uncertainty about where mortgage rates are going, for example, means that turnover is actually the casualty of the housing market at the moment. The market's very sluggish. So I think Rightmove said things are selling, but taking a long time to do so.
How divided is the housing market in the UK? Because at the top end, it feels like people without mortgages, that's where we are seeing a lot of the movement happening. But down further, sort of into the lower price levels, where mortgages have a much bigger impact, you're seeing a very different market.
That's absolutely key. I think it's very, very difficult to talk about the UK housing market. For a start, we're talking about 63% owner occupation.
Yep.
So, it's still the majority, but not as high as it used to be. And of those 63%, more than half own outright. So cash has become really important in the marketplace. And I think purchasing power now isn't just about mortgage affordability.
Yeah.
It's about much more than that. So you've got different sections of the market behaving quite differently because the purchasing power is there with some people and just not with others. And renting is such an important feature now of the market. So we've got, I think, a polarising market, but an increasingly polarising or increasingly segmented market.
We get very excited about rate cuts. We spend our life talking about whether or not we're going to get rate cuts. Are we going to get them this month, next month, or many months in the future? But the market responds in real time in housing off what happens with swaps. And you take a look at what the swaps price charts look like, 2-year, 3-year, 5-year. The volatility we've seen in swaps makes pricing a mortgage really, really difficult right now. Is it the level that's causing problems or just the volatility of the number that's causing problems because of the uncertainty around those numbers?
Oh gosh, how long have you got? I think the thing about the housing market, of course, is that it's actually a long-term market. People are making long-term decisions. So these temporary changes in swap rates will have an impact maybe on transaction levels, which I think is exactly what we're seeing. But in terms of people's decision-making to buy or not, it depends really on not what mortgage rates are now, but what they expect them to be over 5, 10, even 25 years. So there's a kind of long-term, short-term mismatch in the way that markets work. And I think actually the signs are that buyers have been pretty savvy about the timing of their purchases in the past, taking advantage when interest rates were low. But I don't think that. I mean, I suspect we're going to see much lower rates by the end of this year anyway, and that means I think transactions will start picking up next year and the year after.
Where does international demand fall in all of this? As we see that kind of rise in Asian economies in particular, you've seen even a wave coming out of the Middle East, for example. How does that skew it one way or the other?
Look, these overseas markets are very, very focused on particular locations. I mean, London being the obvious one, Edinburgh, Cambridge, Oxford have seen some inward investment from overseas. So it's a very localised effect. Particular sectors of the market, indeed particular types of property. I mean, the Asian demand has been for flats and apartments rather than houses. So it can have a localised effect, and that it's very closely linked then to the strength of sterling.
Well, and speaking of that kind of central London story in particular, talk to us about the policy changes potentially in taxes, for example, and the non-domicile tax. How does that change the demand story?
Well, the non-dom effect really is related to the broader effect it has on the appetite for UK investment generally and London in particular. What we find is that demand from overseas buyers for real estate is very closely linked to demand for all sorts of other investments as well. So the future of London's financial centre, the future of London as an international store of wealth, if you like, it's very much a place where people go to park their capital, a safe haven, if you like. And I think that is much more significant than particular tax issues.
Right. Yolanda, great to see you. Thanks for stopping by to see us. We really appreciate it. Yolanda Barnes, Chair of the Bartlett Real Estate Institute at University College London. Thank you very much indeed. What are we going to do next? We're going to take a look at the stocks that you need to be watching this morning, including RyanAir, the Irish airline. So some affairs may be flat despite the low capacity we're seeing. We'll talk more about that. Remember, it is Whit Monday as well. Many markets around Europe are closed, including Switzerland this morning. The market open is coming up. This is Bloomberg. Morning, folks. Welcome back. Monday, the 20th of May. Mike Wilson over at Morgan Stanley has raised, you heard me correctly, his S&P target for the year to 5,400 from 4,500. That's quite a big step up, isn't it, in terms of those numbers? But he's basically playing catch-up with the market. So the bearish view at Morgan Stanley is starting to be eroded. The other thing I want to flag as well is the VIX is below 12, which I'm really scratching my head about as well. The market seems really relaxed with the risks that are out there right now. Let's get more of a take on what is happening here. Mark Cudmore joins us, Markets Live Executive Editor. Mark, we've come out of a great week. We've seen stocks on a rally. We sort of failed a little bit Friday to keep that going. Coming into this week, what do you think keeps the momentum with us? And do you think it's going to be Nvidia?
I think Nvidia is the big catalyst out there that might derail us. Clearly, we still have upside momentum. Now, it does seem extremely stretched. There are signs of froth out there, and therefore that makes me a little bit worried. But the overall backdrop, as we've talked all year, remains extremely bullish. The fact is, companies are still making good money. Earnings season has been fine. Growth is doing fine. And yet the world's policymakers are saying they're desperate to provide support whenever it's needed. So we should be in a massive bull market. Has it become a little bit stretched in the short term? Yeah, probably. But until Nvidia, at least, I just don't see what derails it. And I'm not convinced that Nvidia should be what derails it right now. So I think it can go a bit further.
OK, so you're not convinced that Nvidia derails it. But I'm trying to think of, if you do have a stretched market and you have a large piece of the puzzle potentially undermining it, how does that change the narrative? This has been a market that has been driven by narratives, strong narratives. AI has been one of those. How big a piece of the puzzle, how big a piece would it be if we were to take that away? What effect could that have in terms just the way the market is set up and just casting a little bit of doubt on the rally? How quickly could things turn, I guess, is the question I'm really asking.
I think they could turn very quickly if Nvidia really disappoints. You're right, Guy, that this has been a key pillar of this rally, a key pillar of the narrative. And therefore, I do think that it could be a major narrative change. But for that to happen, Nvidia earnings would have to massively disappoint. I think there's volatility expected around the earnings. I think a mild miss wouldn't do it. I think we'd have to have just a complete shocker. And I think we're too early in this cycle. Even as someone who thinks that the AI hype is maybe a little bit overdone in the short term, the structural story is valid. We've got a little bit ahead on some of the earnings and some of the revenue plans at the moment. I think we're a little bit early in that cycle for the shocker to come this week. And that's why I don't think it's going to come.
All right, Mark, don't go anywhere. We want to get your take on a few more macro topics because Nvidia, we were talking about this earlier in the show, it is a lot of the earnings story. It's a little bit of a macro story as well. Is this a risk-taking environment that you're starting to see have a little bit of momentum in other places as well? And Mark, we're going to come back to you in a moment. But before we do, I want to bring a chart that caught my eye. We were talking about copper a lot lately, of course, in this show with these massive moves that you were seeing in the copper market. Now, some of this is bets on simply this underlying shortage. Some of this is this kind of contango effect that you've seen in the metals. Another piece of it as well is some kind of really wonky contract things that are going on. I'm not going to get into the wonkiness, but I do want to show you just how big the moves are for the LME contract. A 2 sigma move, a 2 standard deviation move. And that's what you're really seeing on a one-year basis. You go into the right side of this chart. It is highlighted with a circle. A lot of lines here. Don't let them confuse you. But basically, this fact that you were seeing this massive move. You looked at the contracts over in Asia. It is a 3 standard deviation move. It's interesting that we're talking a lot about the metals because it's not just copper, it's gold as well. At the meantime, we're seeing very little volatility in oil. Mark, I want to bring you back into the conversation here because when I think metals, I also think about the translation to the FX space. And I think this is really your area of expertise, the emerging market read-through that you're seeing from a lot of this metal story. And that's what I want to come to you next. When you look at the likes of the Mexican peso, the Chilean peso, for example, even the Brazilian real, in this idea of a risk-taking environment that may have more legs, what's your take on the EM/FX story?
Yeah, it's a great question, Kriti. So first of all, going back, I think that this copper story is in line with the kind of euphoria that we're seeing elsewhere, and that we're just talking about that with Guy there, that there's a fundamentally just very, very strongly bullish picture out there. Has it got a little bit carried away in the short term? Maybe so. So I guess, kind of go to your question, Kriti, what are the asset classes that aren't yet priced in this euphoria, haven't got carried away? And I think you're right to draw attention to the EMFX space. I mean, Mexican peso is maybe less clear because that has appreciated a long way recently. I think the guts of that rally is maybe behind us, but there are other currencies out there. Things like the Brazilian real, which offer incredible carry. That the political fears have proved to be over kind of rot as usual. And therefore, I think that the Brazilian real, Chilean peso, currencies of this are undervalued and perhaps have more sustainable gains going forward. And I think that's the case for other emerging market currencies as well, not just in the LATAM space. I think Rand as well can get this kind of tailwind from that metal story. There is election risk there as well. So I think you're absolutely right. If you want to know if we are in this everything rally, which copper, commodities across the board, crypto, meme stocks, AI, global stocks would all say it's in there. Why haven't emerging markets fully caught the bug? Even Hong Kong and China is going to. So surely the rest of EM has space to catch up, and I would think so, yes.
Oh my gosh, and Mark just talk about meme stocks? How exciting. Mark, we were talking about in the break when the last time the VIX was below a 12 was. I did some funny little kind of handy-dandy terminal science. It was December 2019, right before that big crash that was really COVID-driven. The story in December 2019, I think it was back on the day when I was on the Markets Live team with you, was this idea of momentum. Tech was trading at these extreme valuations. It was seen as a momentum trade. I'm having a little bit of deja vu. Mark, when does it flip? What do we need to see for this kind of euphoria that we're seeing across assets to flip?
Well, back then, to use your example, it was a true black swan situation. It was a pandemic that, like we hadn't seen for 90 years, and therefore I think that it is probably going to have to be something massive. If it's not a black swan, it has to be at least a grey swan, like Guy's idea of an Nvidia shocker. Yes, that would do it, but I don't expect that. It would have, none of the obvious things, so either a major change in the growth story or a major change in the rate side, can happen that suddenly. They need a number of data points to change that narrative, and therefore I think the options are here that maybe if it's stretched, we might consolidate a bit, so bounce around for a few weeks just to kind of burn off some of those excess moves, make the charts look a little bit healthier before we go again. But I don't see us suddenly swiveling to a bearish narrative without some kind of black swan like we saw last time around, Kriti.
Mark, do you think we're now in a situation where we are seeing markets pricing out all the risks? You talk about this kind of really strong momentum. We talk about the kind of black swan events. You can't predict a black swan event. But the markets seem to be in a position now where investors are looking at the tail risks and saying, we don't think those are going to happen. And therefore, you get this huge concentration in the middle of the distribution of outcomes. And I'm wondering whether or not you worry about that, this comfort level the market seems to have with the outcomes that it's seeing. The VIX is below 12. Everybody seems to be comfortable with what they see in front of them. Isn't that quite a concerning environment? Is complacency maybe the wrong word, but isn't this an environment where the market should be thinking more about the risks and isn't?
The risks, they're not aggressively priced. I don't think they should be aggressively priced yet, but when they're priced so low, and perhaps the asset class where this is most obvious is credit, that means that when something bad happens, it can be really, really painful. So from that point of view, you're right, Guy. Like it's when it's cheap to put on the hedges, that's when you should kind of put on those insurance hedges. I just say, just because the market is priced very little risks, doesn't kind of manifest risks into existence. It says that if something bad happens, if a black swan happens, it'll be very, very nasty, and therefore if it's cheap to put on insurance, put on insurance. But it's not a reason in isolation to turn bullish. That will come at some point. But at the moment, we have stretched pricing, but not too stretched.
Mark, thank you very much indeed. Great stuff. Mark Cudmore, our Markets Live executive editor. You want to get Mark's thoughts, you want to get the rest of the team's thoughts, there's a very easy way to do it. All you got to do is go to your Bloomberg terminal, MLIV, go. You're going to find what they think. It's worth reading. It's going to be an interesting week, I think, so it's probably worth digging into this Monday. Let's figure out which stocks we're watching. Joe Easton has all the details of that.
Morning, guys. So RyanAir is in focus today as the company reports a jump in net income, but also does warn of a decline in some fares as they're having to do more discounts than expected in order to fill their aircraft over the summer. Now, they have also done a €700 million share buyback, so that could be a positive on that one. In terms of the stock over 1 year, it's up around 16%, but just a couple of weeks ago, we did see Michael O'Leary warning of a potential softening in prices, and we did see the stock come down. So some of that might already be priced into the market, given those comments a couple of weeks ago. In terms of the old rivalry against EasyJet, RyanAir is the big outperformer. Since the pandemic, EasyJet's had more issues with debt and also strikes over at Gatwick, so RyanAir is the clear winner, but those cautious comments on pricing could be an issue today. There's the analyst ratings, 22 buys, not a single sell rating on RyanAir, everyone really positive. They may be caught blindsided by this one today. Then in terms of your video games, we've got a big takeover in the UK. Keyword Studios getting an offer. This is from EQT, and it's a massive premium. It's a premium of around 70%. There it is on the screen. It's worth £2 billion, 74% premium against Friday's closing price. Now, Keywords designs video games. Some of their clients include the big names like Tencent and also Electronic Arts and Nintendo as well. Now, if we look at the longer-term price, however, we can see that the stock was actually trading around that level less than a year ago. So some investors might not think, even with that premium, it's not even that good a deal in terms of what they're getting for their money there. If we look at some peers worth keeping an eye across the sector today, there could be a bit of a read across Frontier Developments, Embracer, CD Projekt, which is the maker of the Witcher game over in Poland, Ubisoft. All of those could be in focus. We've had a few profit warnings out of that sector over the past year or so there could potentially be a bit of a relief. We might get a bit of a read across in that one. Then we're moving over to cars. We've got the German automakers in focus. Morgan Stanley, much more bearish on the sector today. They are predicting underperformance due to prices declining, adverse foreign exchange movements as well, capex too high, tariff issues between the China, US and the EU. All of those are an issue. So they downgrade a couple of them. They do downgrade their ratings on the Volkswagen and they upgrade Mercedes. That one comes up to a buy. They also cut Porsche. So the two they're downgrading is Porsche and Volkswagen, recommending selling those two, but buying Mercedes because they have got a buyback and also some of their margins potentially priced in on that one. But look at Mercedes, 20 buys now on that one. That could be an outperformer, but keep an eye on Volkswagen. That could be an underperformer this morning.
That 30% one-year decline on Porsche is really eye-watering. Our equities reporter, Joe Easton, they're walking us through some of the stocks to watch. In just about 5 minutes' time, we're going to come to you with the market open. Remember, we do still have a couple of markets closed, right? Switzerland,
but the
Denmark.
main ones are Switzerland and Denmark we need to be watching out for. So it's Whit Monday, as a result of which you've got a few markets that are closed. Right? There's a lot of ex-dividend as well in the market. We should probably be talking as well about this BHP bid. We'll talk about that a little bit later on in the programme as well. Futures, it's going to be an interesting week. We'll talk about that in just a moment. This is Bloomberg. Monday, the 20th of May, we have the post-Pentecost Whit Monday affecting some markets here in Europe today. So in terms of what's closed, you've got Denmark closed. So think about the impact on Novo Nordisk. That's going to have a fairly big effect. Hungary, Iceland, Norway and Switzerland. Switzerland obviously is going to take out some big heavyweight stocks from the market today. So just be aware of that when you look at the trading screens in front of you and what's going to be happening there. You've also got a lot of ex-dividend stocks in the market as well this Monday. That needs to be factored in as well. But we come off a week in which we've seen really strong performances from stocks. We've kind of faded a little bit Friday. Couple sounds very positive. The market's obviously looking forward to Nvidia. I'm curious to see what the catalysts look like.
It'd be interesting. We just heard Joe Easton there talking about the stocks to watch, and he mentioned gaming. Yep. Actually, this could be where one of the headwinds comes for Nvidia. Yes, data centres are the main customer for Nvidia, but one of the headwinds could be gaming, that demand not keeping up with supply in terms of Nvidia.
The data's not there this week to provide the catalyst either. Yeah. So does that mean we're kind of leaning more on Fed speak, central bank speak, Bank of England speak, ECB speak this week as well? And is that going to... with the absence of the data, does that create much volatility?
We are definitely going to be moving on the Fed speak. I think every single word, there's the sheer volume of it. I think what it's going to highlight, though, and Lizzy made this point earlier, is this kind of division that you're seeing within the Federal Reserve. And I think the more mixed messages we get, the more volatility that naturally breeds. But the problem is, do we end up kind of in the way that we've ended up in the last couple of, I want to say, weeks and arguably months, where on Monday you have all this Fed speak, all these things to anticipate, and on Friday you say, well, net, we're right back to where we started. At least that's the bond market story. The equity market story will be fairly interesting as well.
So the Stock 600 finished last week at 522.94. A little bit of a fade, as we say. Friday was the story for equities, but it was a really solid week in terms of the overall performance. So we start this Monday with a few absentees, but nevertheless, let's see how we get going this at the start of this week. There are a few earnings that are going to continue to creep through, and we're going to continue to watch what happens there. I'm intrigued to see how the market takes RyanAir today. I think there's a macro read, not only off Nvidia, but also off RyanAir. So we'll see how that trades. In terms of the early action on the upside, some of the miners look like they're front and centre. Unsurprising, given what we're seeing in terms of the metals trade that we're watching. Copper through 11,000, gold on something of a tear as well. Yeah, so you got your Shells, your Rios, your Anglo-American as well. Glencore, I think, pretty heavy volume as well. I'll also highlight that you're seeing some of the banks higher as well. Lloyd's, for example, is up. You see Barclays is one of your biggest upside movers. To the downside, though, HSBC is going to be one of your biggest weights, at least on the FTSE. AstraZeneca as well, seeing a lot of pain. You can't necessarily compare that to what the sector is doing simply because those closed markets in Denmark and in Switzerland.
Ireland as well, so keep an eye on kind of volume when it comes to the healthcare sector there. But Standard Chartered as well, there's an interesting banking story, some divergences here between some of those companies.
AstraZeneca out with some news a little bit earlier on, talking about building a £1.5 billion pound plant in Singapore.
Well, that'll do it.
Which could be a factor behind all of this. But I think it's interesting that what you are also seeing with Astra is kind of where they're positioning themselves in terms of where that manufacturer is going. The UK is making a really big push at the moment to attract more of it. Interesting to see that it's going to Singapore. I think we've got a capital markets day coming up over the next few days. In fact, I think it might be this week. In fact, I think we're going to be joined by Pascal Soriot this week to talk about what is happening with the business. So that's a story that we want to watch out for as well. It does look as if some of the banks are a little light around Europe this morning. So Intesa Sanpaolo is soft, as you say, Kriti.
I'll also add the ASML is one of your biggest weights on the stock 600 as well. So perhaps that early tech trade showing up as well. But as we hit it, some of the kind of main mining stocks, Rio Tinto, Glencore, are your biggest ones. It looks like we're still waiting for some of the data to perhaps kind of seep in through. Again, ASML is the one that I have my eye on here. Is that just simply a sell tech ahead of Nvidia story? They're two completely different companies, do two completely different things. But as kind of the heavyweight du jour, is there a trade there?
But they're part of the same ecosystem. You think about the three stocks that dominates that kind of AI trade. ASML is definitely one of them. Nvidia's kind of one of the other ones. And then TSMC, which kind of does all the manufacturing, is the third one. And it's increasingly they're seen as being this kind of group that travels on their own.
Yeah, and you already had those TSMC sales 60% boost in April, so that gives you the positive headwinds going into the Nvidia earnings.
Well, I think one of the issues as well with the chip sector is you don't actually know what is the leading indicator, because remember when ASML came out with those really poor earnings, for lack of a better term, and then you had TSMC coming out with this massive profit growth as well. What is kind of is it the dog wagging its tail versus the tail wagging its
wagging
dog?
the dog.
Something with a puppy is happening in the chip sector. It's important, though, to talk about kind of what is actually moving the market and what that actually says about risk sentiment. Isn't that the big conversation we've had? How much of Nvidia is, at the end of the day, a macro story, is a euphoria story?
It's been such an interesting combination of kind of how the macro has interacted with the micro, and Nvidia kind of falls between those two stools, I think, in terms of the impact that it has. But the macro signals certainly have been quite positive. The earnings story has been reasonably positive as well. There are a couple of things I would flag out of that. Last week, I thought Deere was really interesting in terms of what it told us about what's happening in the manufacturing space. Starting to see maybe some weakness creeping in there. We kind of talked a lot about this on Friday to get us kind of sense of what was going on. And in terms of the guests we spoke to, Nancy Curtin had this to say about how she sees this market set up.
It's been our view that the Fed could remain cautious here, may not cut rates at all this year. But so far, economic growth and earnings growth, we think, will trump what's going on in terms of the Fed policy. Remember, liquidity is pretty generous. Look at corporate issuance. Look at corporate spreads. We've reduced QT. We've got bond yields coming down. These are all kind of positive signals.
All right, Alti International Operations CIO Nancy Curtin. It's fine, I'll tag, all good. I think what's important to hear about this is kind of this idea that she's talking about these positive signals, something the guy highlighted at the top of the show when it comes to the likes of Mike Wilson, for example, is Uber Bear also saying it's perhaps a sunny macroeconomic environment. Let's bring in one more voice in that conversation. Iain Cunningham, head of multi-asset growth at 91 UK, joins us right here on set. Good morning.
Morning.
Are you as positive as everyone else seems to be?
I mean, on a broad basis, there's a lot of different things going on. I mean, there's a lot of there's elements of increasing stimulus coming out of Asia, so they're trying to clear prices of property. I think across Europe, we are seeing some dynamics in Europe where things are picking up a little bit in the short term, and then within the US, the economy remains pretty solid and robust for the time being.
So it sounds like you are quite positive then. Is this simply positivity? Is this optimism, or is this euphoria? How are you thinking about it?
So I think I guess when we look at market dynamics, there's a couple of signs within markets that there might be a bit of excess liquidity and some
like
euphoric action taking place. And obviously, we've seen some of the meme stocks starting to come back. We've seen some pretty impressive price action in some of the tech space. But on a broad basis, I think we're sort of nowhere in the realms of where we were in 2021, when there was obviously huge excess liquidity and lots of speculation taking place across all sorts of different markets.
And Iain, last I checked, you'd raised your net long US dollar position quite significantly, and then the dollar headed for its first monthly decline this year. So I wonder what your thinking was behind that, and whether you're not convinced that the Fed's actually going to cut rates at all this year.
Sure. So I think earlier on this year we were starting to rebuild those dollar longs on the basis that we were seeing increasing prospects of divergence. So for us, I guess the probability of the US actually holding up better here has increased. And ultimately, we've expected policy to continue to feed through in Europe, i.e. sort of leading to a continued soft outcome. We expect more disinflationary pressures coming through in Europe and the UK in particular, given that a lot of the prior excess inflation was driven by energy shocks. So it was sort of cost push inflation, whereas in the US it was more sort of excess stimulus and significant amounts of liquidity that was driving those inflationary dynamics.
So you might have divergence between the Fed and European central banks, but what about within the European central banks, between the Bank of England and the ECB? Maybe not just at the start, but how much divergence do you see throughout the easing cycle?
So we would say, I think when we look at both the ECB and the Bank of England, there's a pretty good chance they're going to go in June and then continue to ease. And we'd expect more pronounced easing cycles in Europe than we would in the US.
What's your level of conviction at the moment? How certain are you of outcomes? Because it strikes me that protection is really cheap. VIX is below 12. You can go out and you can buy upside, downside protection, certainly on the downside, very cheaply right now. Why is nobody buying it?
So, on your point of conviction, I think we'd openly admit that the spectrum of potential outcomes feels wide at the moment. Yep. And I say that because we still exited out of this era of exceptionally easy monetary policy, and there are risks associated with that as we continue to trundle forward, and that policy feeds through particularly into corporations and into household refinancing, relevant in Europe. But then when we look at the other side of the spectrum, we've got a world-changing technology that's with us, and we've got central banks who want to ease, and that the Fed seem to be setting a relatively high bar not to ease later on this year. So you've got potentially increasing liquidity conditions.
And the latter just kind of dominates the former. There are risks, we don't know about them, but if you've got those two trends in place, don't worry about that. Just keep going.
So there's those trends, and then some other really big key trends are everything relating to everything that feeds through into decarbonisation spend, defence spending, and the broader infrastructure programs that particularly sit within the US. So there's a CapEx cycle underway under the surface as well.
Iain, is this the calm before the storm? Before everyone starts to price in the election risk, the geopolitical risk, is this kind of why everyone's maybe coasting, maybe why the VIX is below a 12 right now?
So I think, as you say, there are event risks on the horizon. And as we move into the US election and then some of the policies that may come out of that, there are risks associated with certain parts of the world. So I think ultimately when you look at various different dynamics, credit spreads are exceptionally tight at the moment, so hedges there could be relevant. Obviously, within equity markets, there's potentially hedges as well in terms of just generic options, but obviously markets can be quite dynamic, and we can end up with our puts pretty far out the money pretty quickly. And then within currencies, there's some interesting dynamics. Obviously, volatility in currencies is exceptionally low as well, particularly in some of the Asian crosses. And if we start to see increased protectionism and the like, tariffs, then there's some interesting things to play there.
Just on that geopolitical news, of course, we have had various developments today from Iran, Saudi Arabia, Israel as well. I wonder if you share some analyst scepticism about government rhetoric on defence spending actually translating into benefits for defence equity stocks.
Yeah, so I think for us, I mean, the key, I guess, when we're looking for positions, we're ultimately looking for positions that can benefit from a broad spread of different dynamics. So we would say the materials space has pretty strong underpinnings from multiple different angles. So it's more those areas that would be keen to get involved in.
What are investors' objectives at this point? When you talk to investors, when you think about kind of what they want to see, what are they telling you about how they see their story developing over the next sort of 6 to 12 months? I'm not talking about sort of years out, but if you think about kind of what investors are doing right now, are they in capital preservation mode? Are they in capital allocation mode? They want to make sure that they're part of this rally. What are their biggest fears right now? Is it missing out? Is FOMO still part of the narrative? Is capital reservation after a decent run part of the narrative? And how are those two kind of shifting right now?
I think you'd probably say 2021 there was a lot of FOMO.
Yep.
2022 there was a lot of capital preservation going on, and we're probably somewhere halfway in between now.
So FOMO's still part of the narrative.
So we would say ultimately there's clients want to participate in these moves in markets.
Are you worried a lot about a short squeeze? I mean, if you have this much momentum here, are you speaking to clients and saying, why aren't we more invested, for example? Why are you even more bullish on this?
And I think it's different across different parts of the world. So I mean, you could say this is going on in China and Hong Kong now.
Yeah.
There's a lot of people very underweight that market, and there are policies coming through that are not yet game changing, but there's policies there that are trying to put a floor under things.
Just in two. Kriti wants to talk about dividends and buybacks, I'm sure, at some points during this show. How much of that is a relevant part of the conversation right now, that they believe that actually the dividend and buyback story is just so strong that it wants to keep you invested because you're just taking out stock at such a rate?
Is this in China specifically?
No, here in the UK,
elsewhere?
here in Europe and broadly in the States too.
Yeah. I mean, ultimately, I think there's parts of the world where you've seen quite a lot of capital market reform. So parts of Asia in particular, there's been efforts of authorities to force buybacks and force dividends. And then I think more broadly across the world, those dynamics remain ongoing from this cycle or the past 10 years where you are seeing a lot of money chewing up those shares.
But is that just a function of excess profits circa 2020, this kind of massive capital issuance, for example, that a lot of these companies had on both sides of the Atlantic, these record numbers in the bond market? Is this just a carry through from 3 years ago?
Well, I think if you look at various corporations, obviously the smaller cap end of the spectrum is struggling to some degree because there's quite a lot of leverage in there, and it's sort of a bit too speed. And then on the other side of the spectrum, you've got a lot of companies sat on a lot of cash who are going to be progressively returning that to shareholders.
OK. Iain, great stuff. Thank you very much indeed. Iain Cunningham, Head of Multi-Asset Growth at 91. Right, Joe, what's happening with the stocks? Walk us through some of the single names.
Only one place to start, and that is in video games, because we are seeing a 63% gain in Keyword Studios here in London. Surprise, surprise, that is a record gain for that stock. And we're also seeing a bit of a feed through into some peers like Frontier Developments, up 7%. Clearly a bit of a read through in that one at the moment. Keywords is a designer of games, as we said in Stocks Watch. It's actually based out in Dublin, but it is listed here in the UK. We're keeping an eye on Embracer and also Ubisoft as well. Keywords actually a client of Ubisoft. Ubisoft had its own broker move today, but that is the clear movement. We've got another UK takeover by a foreign entity as EQT comes in, seeing some cheap valuations in the UK. Then, speaking of UK, we'll look at a couple of mining stocks. We did have that gain in copper. Copper was up 2.7% early in the UK today, and also the gold price is the one standing out, up around $25 this morning, and that is boosting a couple of precious metals miners today. Hochschild and Fresnillo, both of them gaining more than 3% this morning. Glencore and Anglo obviously more focused on the copper, iron ore, those kind of base metals, getting a boost as well, so all of them moving higher today. We'll have a look at RyanAir. There wasn't too much movement on that one. They have warned of a slowdown in some pricing as they discount heading into the summer, but coming down 0.7% at the moment. That was kind of priced in, given Michael O'Leary, given those shock comments a couple of weeks ago that moved the whole sector. But RyanAir slipping a bit now, down 0.7% on the Dublin Exchange. Then we'll look at some real estate stocks. A couple of things to bring you today. UK house prices at record highs. That's not what we want to hear if you're in the market to buy, but we are seeing a bit of a boost in Persimmon, Taylor Wimpey, Berkeley, the home builders. It was actually up less than expected by economists, but nonetheless, the house price is rising according to Rightmove. And then over in Sweden, obviously, I'm never going to try and pronounce that, but that is SBB, and it's down 6%. They have got a bit of a warning out from Fitch on their debt over the weekend, and that is getting hit a little bit on the market over in Stockholm today, down 6% on that one. I'm sure some people will be able to pronounce that, but I won't. Now, in terms of German autos, we did mention that in the Morgan Stanley note, and both of those ones that are downgraded to underweight are declining. That's Porsche and Volkswagen. MS recommends selling them. They do keep an eye on Mercedes. A lot of this is due to prices coming down. Though Mercedes has a decent buyback, so they kind of like that one. But those stocks are underperforming. That Morgan Stanley recommends selling over in Germany. Finally, from Beamers to Aston Martins. This one more positive. HSBC, for the first time ever, recommends buying Aston Martin. They had yet more weak results a few weeks ago. The stock fell. HSBC sees an opportunity to buy. We're getting a big move on that one, up 3%, 180 price target, trades at 145, plenty of upside. That one's moving in London today.
All right, Joe Easton from our equities team, we thank you for the update on the stocks on the move 15 minutes into the open. And Kriti, you've been telling me you want to talk about video games. I did not have you down as a gamer.
I know, I'm not at all, but I think for our global audience, you should know that when I first started out at Bloomberg as a wee intern back in the glory days, my two stock beats were video games and marijuana stocks, and this was October 2018.
There's a reason for that combination?
I think it was just at that point, it wasn't this kind of booming industry that it is now, and they gave it to the intern because they wanted, me out of their hair, and it ended up being the best learning experience because guess what happened, 5-6 years later? It's the two industries that have had, I would argue, the most growth right outside of, the tech sector. So,
can I just say, weirdly, as an intern here in the UK at Bloomberg, I too had to cover the marijuana industry and brought a T-shirt back for my husband where he wears it in the airport. People look at him really weirdly.
I'm sure. The takeaway from my mind, though, this morning on both of these trades, apart from the fact that I think these days are the Kriti's glory days, but we'll kind of park that one for the moment, is the level of takeovers in the UK. You could go back to the BHP story and the Anglo story. That obviously is at the other end in terms of the cap scale. But there are... Every day, it seems, at the moment, we are talking about deal flow out of the UK, people recognising maybe just how cheap the UK has become. In some ways, it still looks cheap. So does this momentum continue? I was told months ago that there were loads of deals in the pipeline. We're now starting to see that evidence.
Yeah, and we're going to get into this later on, but just on the BHP Anglo point, it really ties back into the copper story, because that's surely a huge reason why BHP wants Anglo American to be the biggest copper operator in the world.
Are we going to be happy in the UK, though, potentially to lose that stock out of the FTSE 100? I think there may be a lot of annoyance. We'll find out on Wednesday, because that's the put up and shut up moment. When we get to that, what is BHP ultimately going to do? And as owners of Anglo, it looks like Anglo is going to do all the hard work. And if BHP wants to come back in 6 months' time, would it be a much higher valued company? We'll continue the conversation around UK stocks and what's happening. Globally, stocks are going to be affected by the next story that we're going to be covering. Wall Street bracing for T+1. We're going to explain what T+1 means. It's basically about how stocks are settled and how quickly that happens. It's going to happen within a one-day period, down from 2. What impact, what ramifications will that mean for global stocks? Also for global FX as well. That's a big part of this story. We'll talk about it next. This is Bloomberg.
This is Markets Today. We're 21 minutes into the European trading day. Flat to the upside on the stock 600. Energy and basic resources leading the gains this morning, as you might expect, given the moves on gold and copper. But we're going to talk about the plumbing now. Wall Street gearing up for a major shift to faster US stock settlement. When markets open next Tuesday, the time allowed to complete every transaction is going to have to be halved to a single day. Analysts fear the change may bring a spike in the number of failed trades, operational glitches and additional costs. So let's get more on all of this with Bloomberg's Greg Ritchie. Greg, you've written a great piece about this. I wonder what it actually involves to change this behind the scenes. Where are the pressure points?
Thank you. I mean, basically lots of processes which currently there's plenty of time to do have to be done in a matter of hours. And it's a bit of a misnomer. We're saying it's a one-day settlement cycle. In reality, a lot of these processes, the time to actually conduct them is much shorter. So let's say you complete a US equity transaction at 4 p.m. New York. You've only got 5 hours to affirm that trade with your broker-dealer in the DTCC at 10 p.m. So it's all these sorts of things when you consider how much volume is going through US securities markets. That's where people are concerned. And people have made preparations, but ultimately, even if you as an institution are very well prepared, is your counterparty prepared? Are all your intermediaries prepared? You can never be entirely sure, and that's why there is anxiety.
That's the stock story. Then there's the FX story as well. It requires an extra kind of component of funding as well. Where does this go wrong? Where's the biggest kind of challenge here?
You're exactly right to highlight that. I think it's quite ironic that this is the US regulation, but it's going to be Asia-based institutions, Europe-based institutions, because they have to buy the dollars before they buy their US stocks, their US securities. Now, the time to do that is going to be massively compressed, and they're going to have to conduct a lot of FX volumes at the end of the New York session. Right now, if you're a currency trader, you'd far rather be transacting when London is online, because that's where a lot of the liquidity is.
Yeah.
Doing it at 4 to 5 p.m. New York, we're not used to volumes at that time of the day. We don't know what's going to happen to bid-offer spreads. We don't know how much new volume is going to shift there. That's the uncertainty, and it's a cost that's going to have to be carried by Europe and Asia-based institutions.
I think a lot more people are going to be working on Friday evenings that were working previously on Friday evenings. Yeah. It's not great. I'd say Friday evenings, very pleasant. Anyway, Greg, thank you very much indeed. Really nicely written piece. Really enjoyable to read this morning. Greg Ritchie on our Big Take today. Another factor we've been watching very carefully with the way that markets are working has been this huge pickup that we've been seeing. We referenced this earlier on in the programme in terms of buybacks here in Europe. Now, Europe has traditionally been driven by dividends if we're talking about how companies think about ways of returning money to shareholders or at least boosting their asset base. In the States, buybacks have been a much bigger feature of the landscape, but that has changed. It somehow coincided with Kriti's arrival here in Europe, or certainly our recognition maybe of it. We were talking about this Friday. Kriti wasn't here, so we wanted to come back to the subject. Cole Smead, the CEO of Smead Capital Management, joined us around the studio on Friday to discuss this. This is what he had to say about the European approach.
There's a myth out there that there's this American style of capitalism that only Americans can do. It's crazy when I hear that. It's like, oh, yeah, buybacks were created for Americans by God? No. This is capitalism. It's just that the Americans have been a lot more aggressive in that style of capitalism. But again, using Orchell as an example, he's been doing those same things. Did the Americans say, oh, this person over here is doing it, I should go own that and make a lot of money? No, they were losing money in banks that disappeared a year ago. What I like here is optimism's low, okay? What I don't like here is there's a historical stigma around buybacks. I don't get it. It's like they treat it like the gnomes of Zurich. If they raise their dividend, the gnomes of Zurich are going to come out of their woodwork and they're going to pour money to their hedge funds and buy the extra income that these stocks provide.
Thoughts?
He doesn't get it. He doesn't get it, Guy. I think it's as simple as that. There's a regulatory scrutiny around this as well, right? Yes, there's a historic stigma, 100%.
Yeah.
But the reason that buybacks, dividends happen so much in the United States, it's not just a capitalism kind of American story. It's because there's an incentive to do it. You're doing it through pension holders, through massive endowments, college institutions, for example. That kind of passive investment does not exist in Europe. It doesn't exist in the FTSE. It doesn't exist in the same way it does in the U.S. So I think the incentive, one, is diminished, and two, there's also a regulatory standpoint.
There was always this view that buybacks were open to manipulation. I've never really understood the difference between that and a dividend story, but there's always been this kind of idea that you were incentivized as a CEO to do that, and the incentive was different when it came to dividends. But it does seem to be taking off now here in the UK, and certainly seems to be taking off more broadly across Europe. So it's going to be interesting to see whether this is a trend that continues. It does, to a European operator, feel like an American trend.
Yeah. But this is also a question of excess profits, right? So we're in an arena where this kind of consumer resilience out of the States has really been eye-watering and unexpected, and therefore cue the buybacks.
But that's precisely why it's the oil giants and the banks who are giving those buybacks here in the UK, giving the FTSE some hope moving forward. Coming up, as the Iranian news agencies confirm the deaths of both the country's president and the foreign minister, we'll bring you the details and discuss the implications for the wider region. That's coming up next. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day. We're seeing some marginal gains here on the Stock 600 and the FTSE 100. It looks like the party continues when it comes to the global equity market, but a lot of this is led by two sectors in particular. We're looking at a commodity-driven story. A lot of that's following the kind of gains you're seeing in the copper as well, this euphoric tilt that you may be seeing in the macroeconomic space. Banks are kind of split here, though. You are seeing a little bit of outperformance there as well. It's a really interesting market dynamic that we're seeing, but how much of this is a wait-and-see mode for perhaps the rest of the week, Guy?
Absolutely. We're building up to Nvidia. Those are the key numbers that we're going to be watching out for. But there's some key... the M&A story is going to be there as well. Yeah. We'll talk more about this in a little while. But BHP, big deadline coming up on Wednesday, so we're going to watch very carefully to see exactly how we build up into that.
Yeah.
And to what extent is what we're seeing with the basic resources trade this morning kind of the M&A story? I think probably less so and more about what is happening with that big move that we've seen in copper.
Yeah, I'm not saying that the M&A story is what's fueling the copper rally, but the reason that BHP wants Anglo American is partly because of the reasons that are fueling copper, because of the supply problems, right?
We'll come back to that a little bit later on. We probably should turn our attention now to what is happening in Iran. Iranian news agencies have confirmed the country's president, Raisi, and the foreign minister have both died in a helicopter crash. That happened Sunday. Search teams have now located the wreckage. This is in Iran's mountainous sort of northwest region where they had been visiting. Apparently the weather was extremely bad and there were significant amounts of fog. Jane Kinnemont, who is Policy and Impact Director at the European Leadership Network, ELN, a pan-European think tank focusing on European foreign defence and security issues. Jane, what do you think the implications of this are going to be for Iran and the wider region?
Well, it's a shock event in one of the most important countries in the region, but the immediate geopolitical implications may be quite limited, assuming that Iran does not blame outside countries or forces for this death. The Iranian system has got a lot of its own problems and insecurities. It's already dealing with a slow-motion succession crisis over who becomes the successor to the country's top cleric, who's in his mid-80s and said to be not very well. But when it comes to replacing the president, there are enough other forces and people in the regime who are likely to be able to close ranks. They're unlikely to significantly change Iran's foreign policy orientation. But it is still early days, and we don't know what is going to happen in terms of the blame game, whether the government will say this is a tragic accident or whether they will try to cast blame on others.
What would you expect in terms of the political narrative at the moment? Is this something, given what's happening with Israel, given what is happening in the wider region, would there be an advantage in blaming others? I guess is the question that I'm going to ask when it comes to this accident.
I think it's most likely that this has been an accident caused by very bad weather, and Iran has a really poor record in aviation safety. Some of that is partly because it's under sanctions and it finds it very difficult to keep upgrading and modernising its helicopters and its planes. So certainly I think you'll see some emphasis on that from the Iranian government to say sanctions really are deadly. But at the same time, this is a country where they have had senior officials assassinated, both by America in the case of Qasem Soleimani back in 2020, and by Israel, including just a few weeks ago, some senior commanders who were in Damascus at the time. However, it would be completely unprecedented to have interference at this level of politics and with people who are sort of in the government rather than involved in Iran's paramilitary operations overseas. I think Iran probably also won't want to look weak. So I don't think there will be that official blaming, but there will be a lot of conspiracy theories. And of course, there'll be a lot of internal conspiracy theories as well. Some thought that Raisi might be a candidate to become the supreme leader in the future. There is a big internal tussle over that position, which ultimately is more important than the president. So Raisi had a lot of enemies, and there will be a lot of speculation and theories, especially in a country where, for understandable reasons, people don't much trust the official news sources.
Jane, so that is the Iranian story, and of course just one part of the story coming out of the Middle East over the weekend. I want to switch over to Israel as well, because we've got plenty of headlines coming out of there as well. Internal turmoil, you say, in Iran, but perhaps internal turmoil in Israel as well, where Benny Gantz, for example, has threatened that unless there's a new war plan actually presented, he could quit the government altogether. Can you walk us through the dynamics there? What do we need to pay attention to?
So there really is a question about how long Netanyahu can hold on for. We know that if there were fresh elections, he would be thrown out. But one of the factors that has really been complicating the efforts to reach a ceasefire in Gaza is that Netanyahu has to think, of course, about the country's security, but he is also thinking about his own political survival. And indeed, if he leaves office, he will also be vulnerable to various corruption charges. So it's very, very high stakes for him. And essentially, he will need to make a choice. Does he placate the hard right parts of his governing coalition who want to see an offensive in Rafah? Or does he stick with people like Gantz in the War Cabinet, who he doesn't personally like. They're old rivals, but they are more experienced, more professional, and have more international trust. Gantz is probably calculating that if he leaves the government, it could trigger elections. And opinion polls in Israel suggest that most Israelis would rather have somebody else at the helm at this time of profound crisis.
So, Jane, what are we waiting for here? Is it the June 8th deadline that Benny Gantz has presented? Are we waiting for more updates on weapon shipments coming out of the states, Biden policy? What is the kind of game changer, perhaps, for the region here?
Well, it's not completely clear. There have been people trying to oust Netanyahu, for months now. There's a big protest movement, including some of the families of the hostages who are still trapped in Gaza, who are calling for Netanyahu to go and for the government to refocus on hostage diplomacy. A lot of it really still is in Netanyahu's hands. Some people thought that he would be out weeks ago, but he is a real veteran political survivor. And so far, he has been focused on keeping that governing coalition together, even when it has cost him in terms of the public support from the US. So it remains something quite unpredictable.
So you've got the cracks in the Israeli war cabinet. You've got the death of the Iranian president. You've also got the Saudi king in ill health. I just wonder how you gauge the instability in the region, because we haven't seen much of an impact on the oil price this morning.
Well, the Saudi king has handed over most of his powers to his son quite some time ago, and his son is really positioning himself as one of the most influential figures in the region, still negotiating hard with the US to try to get more security guarantees for Saudi Arabia. But there is an issue of leadership. There is an issue of state fragility, and well before October 7th, many analysts were worried that domestic politics in both Iran and in Israel would put those two countries on a collision course. I think especially in Iran, it has really kind of built up this system of non-state actors that are friendly to it around the region, all of which depend on a narrative of forever war, of permanent confrontation with Israel. And it becomes really difficult to make peace when internal political systems are geared towards confrontation, even if it is sometimes more about internal calculations than external ones.
And Jane, just coming back to Iran and the death of the Iranian President Raisi, does it at all open the door back to a more moderate path on nuclear policy?
It's early to say because it is going to depend on who succeeds him. But certainly, since Raisi came in, it became much more difficult for the international attempts to bring back the nuclear deal to succeed. And that wasn't just personally about Raisi. It also seemed to be about the supreme leader losing faith in nuclear diplomacy. But it is possible that you could get someone succeed him that takes a different view. You could get someone who succeeds him. You could get a new foreign minister who are more au fait with the West and better able to work out how they might get to some mutually advantageous understanding. The problem is that since the JCPOA was so badly damaged back in 2018 by Trump leaving, Iran has gradually just built up more and more nuclear capabilities. And it's probably impossible now to get back to where we were with the JCPOA because, it's gained so much technical know-how. The inspectors have lost so much information that, Iran is really the country that has gained in a lot of ways from the nuclear deal not being enforced. So probably the international priority now is to make sure it doesn't convert the knowledge and technology it does have into a weapons program. That's a much lower ambition than there used to be, but it remains something really urgent, as we do know that Saudi Arabia, UAE, Turkey, and others are talking about how they will look at their own options for nuclear weapons if Iran did come to get one.
OK, Jane Kinninmont, Policy and Impact Director at the European Leadership Network. Lovely to see you, despite the circumstances. We'll get back to the markets next. This is Bloomberg.
we're going to grow by traffic by 9% this year to almost 200 million passengers, and we're guiding fares in the peak summer months flat to modestly up, and that's on top of a 21% fare increase. We would hope to have 158, maybe if we're lucky, 160, 161 game changers in the fleet by the end of July. That's roughly 23 aircraft shy of where we had hoped.
Neil Soran, the CFO over at RyanAir, talking to Tom a little bit earlier on this morning. Let's talk more about what RyanAir had to say for itself. It's a little lower this morning, the stock. It met estimates, but it's the outlook that really is where I think the interest lies this morning. Joining us now to discuss, Sid Huff-Phillip from our aviation team. Sid, look, the expectation coming into the summer was that we were going to see strong demand that was going to drive prices. RyanAir is a master of dynamic pricing. We're not seeing that. Why?
So at the moment, I think there's a lot of, airlines expected fares to continue growing this summer, and that really hasn't kept up. So I think people are getting a little more circumspect about spending, especially on holidays. And while demand is strong, while airlines have said demand is strong, that sort of rush where people are willing to pay as much as they can to go on holiday, I think that's sort of fading away a little bit.
So is this a RyanAir story, or is this a broader sector story?
I think RyanAir is a leading indicator for the broader sector, and I think that's what investors will be looking at in terms of how demand pans out going into the summer, because especially with RyanAir, it is one of the biggest low-cost carriers in Europe, and that is where sort of the bulk of the market travels, and that's really an indicator of where demand can go from here.
And how much of a boost did RyanAir get from the Wizz Air grounding, and then how much of a hit can we expect when we get Wizz Air's results later in the week?
So RyanAir was hoping for a massive boost from Wizz Air's grounding, especially because so many aircraft of the A321s are grounded because of the engine issues, and that's what they were sort of banking on, the fact that low capacity this summer would mean prices go much higher. And I think they sort of tempered those expectations now, saying that the prices will be flat to a modest growth. And I think that's sort of indicative of the demand out there in the market.
So this is confirmation that the revenge travel story is over. But the expectation was that, we would see that fading anyway, but the capacity issue would keep prices high. RyanAir's dealing with its own capacity issues, obviously around deliveries of the MAX, the 737. There was an inkling today maybe they're not going to get even as many aircraft as they had anticipated. Now, they've got kind words to say for Stephanie Pope and what she's doing at Boeing in Seattle. But nevertheless, is there a sense that actually the initial numbers may not even be matched?
So RyanAir said they're about 20 to 23 aircraft short this summer from what they wanted to be. And I think they are sort of struggling to get capacity. They were hoping to get as many MAXs as possible because they have more seats on them versus their older NGs. And it gets them sort of way more sort of capacity and allows them to offer more services and more capacity. Their entire strategy is sort of offering routes and then filling them up with low fares.
Sid, we have to get to my favorite topic, which is buybacks and dividends. RyanAir's new to that game, relatively speaking. How long does it continue if we're already talking about these flat fares?
That's a really good question. I think that's what everyone's hoping to see, because 700 million was the buyback they announced today. They've also announced a dividend earlier. And so essentially investors are looking to see what sort of shareholder returns are going to come as they go along. And I think the company still said it's too early for an outlook. But I think that's what everyone's really hoping to see, what sort of investor returns come back.
All right, Bloomberg Sid Phillip, thank you for that. The latest on the RyanAir earnings. And don't miss our interview with Michael O'Leary, the CEO of RyanAir, of course, on those earnings. That's at 1:15 p.m. UK time. Now, we have been talking about what a busy week it's shaping up to be for M&A, a dramatic week. Time running out for BHP to make an improved offer to acquire rival Anglo after 2 bids rejected already. BHP is, of course, particularly interested in Anglo's copper mines, the metal surging to its highest ever level earlier, extending a months-long rally. Well, Bloomberg's Martin Ritchie joins us now for more. Martin, does the fact that Anglo's restructuring plan looks so similar to BHP's bode well for BHP?
Yeah, it's a good question. As you said, BHP has until 5 p.m. London time this Wednesday to decide whether it's going to go for that full takeover of Anglo American, chiefly targeting the copper assets. As you said, Anglo has already put out its rival proposal, saying it will break up the company creating something that looks roughly like what BHP had proposed anyway. There's kind of two ways of looking at that. On the one hand, BHP might want to get this done as quickly as possible before Anglo has a chance to put through its own restructuring and perhaps get a better valuation. This might be the only chance for BHP. On the other hand, I think it might make Anglo shareholders perhaps a little bit more cautious about the bid. Look, they might say, look, we can get something similar from what Anglo management's proposing. Let's just wait and see how that pans out. BHP, we understand, would prefer to have engagement with the Anglo board. Perhaps they will table a higher bid just to try and get the shareholders to pressure management to start talks. But as yet, we haven't heard anything. Waiting for some news from BHP any time over the next 2 days.
It does kind of feel as if BHP is bidding against itself at the moment, which is an interesting place to be, and maybe its shareholders may feel something about that. Martin, let's just talk a little bit about the copper price. It feels like we've got two markets right now. You've got the speculative market, which is driving the price higher, but you've got the real market, which is feeling like it's maybe a little oversupplied at the moment. Why are we getting this divergence between those two markets?
Yeah, it's a very good question, and it really is quite striking, especially speaking here from China, where I think if you speak to people in the copper market here in China, the biggest market in the world, people are not particularly optimistic, not particularly bullish about demand this year. But at the same time, you've got the copper prices going gangbusters in the rest of the world. Copper futures or metals futures are sort of forward-looking assets. So people are really anticipating supply shortages starting to get more serious over the next 12 months or so. We've seen a lot of very bullish, optimistic forecasts of that happening. And that's really what's attracted a lot of speculative money into copper, into the London Metal Exchange in recent months. The idea that this is starting to happen, these shortfalls are starting to appear. But that's causing this dislocation, which you've pointed out, between the price in London and what people might be seeing in the physical markets.
Well, Martin, the kind of euphoria that you're seeing in copper, the speculative pricing, as you put it, it breeds questions of when that kind of market action is going to snap. I'm curious, connect the two for us. Could it snap in time to affect the premium on the Anglo deal? Is there a connection to be made there?
Look, I think it's partly sort of just coincidental timing. I think that BHP has launched this bid, which is very much driven by hopes for copper prices and demand. It's sort of coincidental that it just happens to be happening at the same time as we've got copper prices going to $11,000. I don't think BHP is going to make a decision of whether to go ahead just based on what the copper price is today. I think BHP has made very clear over the past 2 or 3 years that it wants copper assets very much for the long term, for the next 2-3 decades. So obviously it makes colourful backdrop for the bid, but I don't think that's what's at the core of motivating BHP.
All right, we'll have to see how high these prices actually rise. Bloomberg's Martin Ritchie, we thank you so much for that context on the copper market and, of course, the deal flow that we are seeing around BHP and Anglo American. Now, speaking of deal flow, this is, I think, where I can put my Spanish correspondent hat on properly.
You could probably buy one of those as well.
A badge of honor, I think. A sweatshirt, all the paraphernalia. Let's talk a little bit about this BBVA Sabadell deal.
Yep.
You now have Mexican billionaire Daniel Martinez backing it. You have the ECB saying, we're a fan. What could possibly go wrong?
Spanish politics, shareholders, unions, staff. There are many issues that stand in the way of this deal. I still think this deal is emblematic of a problem that Europe faces, which is you can do deals within a country, and even then that appears to be quite hard. Doing deals outside of and cross-border deals, incredibly difficult.
Isn't this exactly what Emmanuel Macron spoke to John Micklethwaite about?
Exactly.
That he's actually ramping them up. I'll also add the other piece of the equation, sorry to interrupt you, was the idea that the Bank of Spain is actually at the same time increasing their standards around lending at the exact same time. They're saying it's not going to happen until October of 2026, but they're saying that reserves that those banks need, that the U.S., by the way, is pulling back on, or potentially reported to be pulling back on, Spain is ramping it up because they're worried about the longevity of those banks.
Well, the point that Emmanuel Macron is making is that you need to have this sort of takeover if you want to compete internationally. So, yeah, it's interesting that you've got the ECB and the second biggest investor supporting it. You talk about the potential blowback later on from shareholders, but this surely shows that the shareholders, some of them at least, do support this deal.
Some of them certainly do, and you can see the attraction of doing such a deal. You need to take out an awful lot, though, in terms of the domestic banking network in order to make this work. There is to make this deal stand up and to really work for shareholders, you have got to take out an enormous amount of costs. And that is going to be something that is politically problematic. Yeah. And I think that is where the pushback may come. I'm not saying that you can't make the deal work on paper, which you almost certainly can. Yeah. It's whether or not you can make it work in the real world and with the politics that go around that.
There's also, I'm curious, I don't think on the record Santander has said anything about this just yet, but Santander is, of course, the largest Spanish bank. Yep. They don't only have massive of a presence in Spain and broader Europe, but in Latin America as well.
And that's why here in the UK and elsewhere.
Right, internationally. But that's why this deal is so interesting, because BBVA, in particular, is more of an EM kind of exposure, whereas Sabadell has more of that domestic story. Together, they actively compete with Santander. And I'm wondering if there's some sort of behind-the-scenes politics, behind-the-scenes lobby about that competition not being a positive thing, but actually almost cannibalizing some of that growth within Spain.
But it's precisely Sabadell's focus on lending in Spain with the counterweight of BBVA's tilt towards emerging markets that reportedly makes the ECB give this support, despite it being potentially a hostile takeover.
I think the bigger takeaway from all of this, though, is that we are seeing some deal flow.
Yeah.
Things are starting to happen. We've got deal flow certainly happening in the UK. Deal flow has been sort of really absent for quite some time. You're certainly seeing evidence of that continuing to push on. Is that something that keeps equity markets on track as well in terms of the rally that we're seeing? I find it fascinating that this is a day when Mike Wilson, one of the biggest bears out there, has finally capitulated and raised his targets. What is there that is standing in the way of this rally continuing?
Well, is deal flow a sign then of good times ahead? Is it an expansionary story, or is it a consolidation story ahead of poor times ahead? And I've never been able to figure out what it's actually a sign of, because you see it at the best of times and the worst of times, and the fact that we can't tell which we're in is a problem. And is it better that companies do deals or that they buy back their stock? Yeah. And kind of what do shareholders ultimately Sophie's choice.
These are tricky decisions that have to be made. But Mike Wilson, it looks as if he has finally capitulated. Is that a signal that maybe the market will take on and think about a little bit more? We're going to carry on the conversation. We're done for this morning. The Pulse is up next. Francine Lacqua taking you through the next hour. I hope the rest of Monday is as interesting as the start. We'll continue to see the build-up to the Nvidia numbers, which come Wednesday. This is Bloomberg.